Europe is suffering the second wave of infections and lockdowns. What is the recovery outlook?
Yes, Europe, like much of the world, is suffering from a second wave, and actually in a number of countries, a third wave. The good news is that things are recovering, albeit quite slowly. I think what we need to remember, though, is where Europe was before the pandemic. And of all the regions in the world, Europe is most exposed to global growth. And that is to say that if the world is expanding, Europe is benefiting. And if the world is contracting, Europe is obviously in a more challenging place. So with that framework in mind, Europe, of all the regions in the world, was one of the most badly impacted by the pandemic over the course of last year. But what that means is that as the world recovers, Europe stands to benefit far better than many of the other regions of the world. So in that regard, we are quite happy with the outlook for the region. If we put that into numbers that we look at in our everyday investing lives and look at earnings growth, we are forecasting very, very strong earnings growth recovery from Europe over the course of this year, more likely towards the second half of this year. But importantly, that continues into next year as well. So overall, the outlook is looking very strong. Equally, like many other governments around the world, we saw the European Central Bank deploy huge amounts of stimulus into the market to support companies and households through the pandemic. Something in the region of 4.5 trillion euros of stimulus has been put into the market over the last year. Now, this in itself is obviously very good. A lot of those initiatives are actually focused towards climate change and renewables. And again, that should be very supportive moving forwards. But what I think a lot of people have missed is that this is almost the first time that we have seen a truly collective response from Europe. So we have this whole concept now of a far more integrated Europe. And I think longer term, that is going to be very powerful for the region and is another thing that we're looking at very positively in terms of the outlook. So to answer your question in short, yes, Europe is still experiencing second and third waves of the pandemic, but actually the outlook from here as the world normalizes is very positive.
How do you allocate your portfolio? Is there any country bias, and what determines the allocation to a particular country?
So the European Union today is made up of 27 different countries. Each or many of those countries have different languages, different tax policies, different politics, a real mix of variety on a number of levels. So historically, it has actually been very, very difficult to predict or to forecast which of Europe's countries stand to do best in a given calendar year. From our side, what we try and do is use our combined quantitative and fundamental investment process to not look at individual countries, but instead to look at individual companies and predict which of those companies are likely to prosper into the future. We are helped in that way by the fact that our strategy is unconstrained. And what that means is that if we don't find any interesting or attractive opportunities in a certain country, we don't have to own them just because it happens to be in the benchmark. Similarly, if we find lots of great opportunities in a certain country, we can own all of those without any concern about the structure of the portfolio. So that whole idea of just having best ideas in the portfolio is very, very helpful to us. If I think about where that investment process and bottom-up stock-specific approach gets us today, we are very overweight towards Germany. We find a lot of really interesting stocks there in the capital goods space, retail, auto companies. On the other side of the equation, we are quite underweight towards the UK. That is not to say we don't find opportunities there. There are a lot, but they're typically towards the smaller company end of the spectrum. So we're actually underweight, or we don't own many of the big, large cap, expensive, defensive companies, which leads to that underweight. So again, in summary, try not to think of Europe as a mixture of different countries. Think of it as a large pool of really interesting companies, and try and pick the very best of those, rather than trying to forecast which particular country might or might not do best next year.
What is the impact of Brexit on European equities?
So Brexit has been a huge overhang of uncertainty for Europe for the last 4 years. And whilst we expect there is more negotiation to come, clearly the deal that was struck recently lifts a lot of that uncertainty away. And we now have a much clearer path for how Europe and the UK will interact into the future. And that in itself is obviously a positive. Now, what has been very interesting is that that level of uncertainty has essentially created a large discount when it comes to valuations in Europe. And I say Europe because Brexit wasn't just specific to the UK, it impacted the whole region. So at the moment, what Brexit has done, or what the Brexit deal has done, has removed a lot of that uncertainty, but markets are still quite slow to react to that. So we're still finding a lot of very attractively valued companies in both the UK and Europe. Now, if I think about the world at the moment, most things look quite expensive, but we need to think about how things look relative to each other. And equities themselves look quite attractively valued relative to, say, fixed income. Europe looks attractively valued relative to the rest of the world. So today, if I look at, say, the dividend yield of companies in Europe, they are trading at around 3.1%. That is in line with the long-term average, but it's a meaningful uplift on what you can find in the fixed income world. So the removal or the clearing up of the Brexit situation is a positive for Europe as a whole. It has created, over the last few years, a big discount. That discount will slowly be removed as investors get more comfortable about the path ahead.
What are your favorite sectors and why?
So if we think back to the earlier question about countries, it's a very similar situation when it comes to sectors in Europe. We prefer not to try and predict which sectors are going to win or lose. We prefer instead to look at it from the bottom up, from a company-specific perspective. And I'll give you an example of that. If you take the retail sector, for example, it is a mix of many, many different companies that have been impacted in very different ways by the pandemic. And actually, those companies stand to have very different outlooks on the way ahead. So if you think about your traditional bricks and mortar high street stores, they've obviously had a hugely challenging period over the recent year as people have been forced to stay in and around their own homes. If we think then to companies that are more exposed to e-commerce, clearly it's the opposite scenario. People still want to consume. If they can't consume in a real high street store, they will start to move to an online alternative. So we've seen a huge acceleration in the number of people using online retail. We believe that shift is not just a one-off from the pandemic. We believe that continues into the future. So you've got two sets of companies here within just one sector, some of whom have been incredibly challenged and potentially will struggle to recover from that once the pandemic passes. And then on the other hand, you've got those companies that have been the real beneficiaries of that shift to e-commerce. So rather rather than just buying sectors where you're going to get a huge mix of companies, we prefer to target in, focus in on the companies themselves. What that actually means is that we can get much more variety in our portfolio. And again, coming back to that whole idea of just holding the very best ideas in the region. What actually excites us at the moment, and this comes back to a point I was just making on valuation, is that the valuation spread, so the difference between the most expensive and least expensive stocks in a given sector, is still very, very wide, at really, really extreme levels. And what that means for us as active managers is that there's a huge opportunity set ahead of us to add even more value than we typically do. So it's a great time to be investing in actively managed portfolios. Thinking about the portfolio itself from a sector perspective, perhaps no surprises here. The sectors that we really like, where we find a lot of interest at the moment, are semiconductors. We like capital goods companies. We like transportation companies. All of the areas that are likely to be the big beneficiaries of the pandemic gradually moving to one side and the world normalizing once again. So similar story to countries. Let's try not to just pick specific sectors. Let's just try and pick the very best companies that we find in front of us.
Compared to US and Asia markets, Europe has not gotten as much attention from investors during recent times. Could you share what are the opportunities for Europe now?
Yes, of course. You're absolutely right. Europe has not received the attention that we've seen in the US and Asia. And in fact, returns in Europe have also been significantly lower than we have seen elsewhere. If we think about that and what that means, Europe's share of the value of the global equities space has almost halved over the last couple of decades. So Europe used to be about 30% by value of the global universe. Today, it's closer to 17%. And a lot of that is to do with what you were actually buying when you bought into a European equity strategy. What sectors were you most exposed to? What sectors were you least exposed to? So if we think back 20 years, the big overweights from a sector perspective in Europe were to banks and to energy. Two sectors that have had a very, very challenging time over that period, and in fact have delivered little to no earnings growth through that time. If we think about the other side of the equation, what sectors were you underweight or underexposed to if you bought into Europe? It was all of those technology-related names in sort of software and services, companies and sectors that have seen huge increases in their earnings ability over like 20 years. So that is really why Europe has struggled over that time period, and that is why investors' attention has drifted elsewhere. The great thing about markets, though, is that they are essentially self-correcting. So by virtue of how those companies and how those sectors have performed, we have actually seen a real rebalance in the way in which the European equity market is positioned. So today, banks and energy and some of those staler manufacturing and sort of tobacco companies that Europe was so well known for are a much less sizable part of the index, instead replaced by some much more exciting and innovative companies that have increased in importance over that time. If I think about what excites us about Europe moving forwards, it's no longer that sort of traditional manufacturing and finance exposure. Today, it's more about things like health tech, med tech, clean tech, all of these sort of buzzwords that we're all thinking about. Europe is actually home to a great number of companies that are leading the way in those spaces. If we take, for example, renewables, 8 out of the top 10 companies in the world that were exposed to renewable energy last year are actually European. So Europe today is home to some really fascinating opportunities. And again, coming back to those earlier points, many of those opportunities still come at a good discount to the rest of the world. The other area that interests us about Europe is, again, related to technology. if we think about the big drivers of returns in the US and Asia in recent years, they've typically been consumer-facing technology stocks. And you will rightly be thinking that Europe is not home to many of these big consumer names. However, what is interesting and what we've seen in the news in recent months is that a lot of these big consumer technology companies are coming under far, far greater regulatory attention. And that in itself is quite interesting. That regulatory pressure, that regulatory attention is very unlikely to reduce from here. And typically, increased regulation leads to reduced profitability. We still think a lot of these names in the US and Asia are very interesting. We still think they have a lot of success ahead of them, but that success may well be somewhat diluted by that increased regulation. In Europe, firstly, we don't have those companies. And secondly, when it comes to regulation, we have been working under heightened levels of regulation in Europe for many, many years. Our companies are used to it. It's very, very unlikely to increase from here. And as such, on a relative basis, actually Europe stands to do very, very well. So bringing all that together and really answering that question about the outlook for Europe in a slightly shorter fashion, we are excited. Buying Europe today is very different to buying Europe 20 years ago in terms of the exposure that you get. There are still companies in Europe that have problems. There are still countries and sectors in Europe that have problems. But actually, if you take an unconstrained and stock-specific approach, you can avoid many of those issues and focus in just on the best ideas. And finally, because of all of the political noise that's been in the background for Europe over the last 5 years or so, many of those opportunities come to us at a very attractive discount to the rest of the world.